Imagine a trading strategy where you lose most of the time, yet still end up profitable. That's the paradox of breakout trading. Most retail traders chase breakouts, expecting a big move, but the reality is that 80% of breakouts fail. This isn't a flaw in the strategy, it's the core design. Breakout trading is a high-reward, low-probability game. The few winning trades are meant to cover the losses from many failed attempts. In this analysis, we'll dissect the mechanics of a breakout trade, from entry to exit, and show you a trailing stop technique that can turn a losing trade into a winner. By the end, you'll understand why most breakouts fail, and how to approach them with a systematic edge. Let's start with the uncomfortable truth: 80% of breakouts fail. This means if you buy a breakout of a range, chances are price will fall back inside. Why? Because markets have inertia. They tend to continue their current state, whether it's a trend or a range. Breaking out requires a significant force, a surge of volume or a fundamental catalyst, to overcome that inertia. Most attempts lack that force. This isn't a pessimistic view, it's a statistical reality that shapes how we approach breakout trades. We don't expect every breakout to work. Instead, we plan for failures and let the occasional success pay for the losses. This is the essence of a high-reward, low-win rate strategy. To understand why breakout trading can be profitable despite a low win rate, we can use a simple expected value formula. The expected value of a trade is the probability of winning times the average win, minus the probability of losing times the average loss. For a breakout strategy, let's assume a win rate of 20% and an average win of 5 times the average loss. Plugging into the formula, we get 0.2 times 5 minus 0.8 times 1, which equals 1 minus 0.8, or 0.2. This positive expected value means that over many trades, the strategy is profitable, even though you lose 80% of the time. The key is to keep losses small and let winners run. Markets are not random, they move in recognizable phases. We can classify all price action into 5 phases: uptrend channel, downtrend channel, uptrend impulse, downtrend impulse, and sideways range. These phases are not permanent, they transition from one to another. However, markets exhibit inertia, they tend to stay in the current phase until a significant force causes a transition. This is why a breakout from a range often fails. The market is comfortable in the range, and it takes a lot to break out. As traders, we should respect this inertia. We assume the current phase will continue until proven otherwise. This mindset helps us avoid premature breakout entries and wait for confirmation. A systematic approach to breakouts involves 4 steps. First, identify the current range or channel boundaries. Second, wait for a breakout of that boundary. Third, wait for a retest of the broken level, which confirms that it has flipped from support to resistance or vice versa. Fourth, wait for a re-breakout in the direction of the original breakout. Only then do you enter. This process filters out many false breakouts. If price breaks out but doesn't retest, you skip the trade. If it retests but fails to re-break out, you skip it. This patience is crucial because it aligns your entry with the highest probability moment. The trade example we'll examine later follows this exact sequence. While we don't have exact statistics, the 4-step logic is designed to improve the odds. A simple breakout without a retest might have a success rate below 20%. Adding a retest and re-breakout could raise it to 30 to 40%. This is a qualitative estimate, not a proven statistic. The chart illustrates the relative improvement in win rate for different breakout setups. The first bar shows a raw breakout, the second adds a retest, and the third adds a re-breakout. The exact numbers are illustrative, but the principle is clear: more confirmation reduces false signals. Let's dissect a real trade from the training material. The setup was a breakout from a downtrend channel. The entry was at 1301, after a breakout, retest, and re-breakout. The initial stop loss was placed below the breakout point. The trade moved in our favor, but then showed signs of weakness. The pullbacks became deeper, and the market formed a potential head and shoulders pattern. Eventually, we exited at 1308, a small profit. This trade is called a half failure because it didn't reach the expected target, but the trailing stop protected the gains. This example illustrates that even a failed breakout can be profitable with proper risk management. In the example trade, the entry was at 1301, the stop loss was below the breakout point, and the exit was at 1308. If the stop loss was at 1295, the risk was 6 points. The reward was 7 points, from 1301 to 1308. The risk-reward ratio is reward divided by risk, which is 7 divided by 6, approximately 1.17. This is a low ratio, but because the trade was managed with a trailing stop, we locked in a profit even though the original target was not reached. The formula helps us evaluate if a trade is worth taking. A higher ratio is generally better, but it must be balanced with the win rate. When trading in the direction of a trend, you need a method to enter on pullbacks. The higher high, HH, and higher low, HL, concept is a practical approach. In an uptrend, you count pullback bars. The first bar that makes a higher high is called HH1. The next time it makes a higher high, it's HH2, and so on. The idea is that HH2 and HH3 are the best entry points because they confirm that the bulls are still in control. HH1 is too early, and HH4 might be too late, risking a missed move. This method helps you avoid chasing price and instead enter on strength. It's a simple but effective way to time your entries in a trend. To determine if a trading strategy is viable, we can calculate the break-even win rate. This is the win rate needed to break even, given a certain risk-reward ratio. The formula is 1 divided by 1 plus the risk-reward ratio. For a risk-reward ratio of 1.17, the break-even win rate is 1 divided by 2.17, about 46%. This means you need to win at least 46% of the time to avoid losing money. In our example, the win rate might be lower, but the trailing stop helps by increasing the average win or decreasing the average loss. This formula is a quick check to see if your edge is real. The most powerful tool in a breakout trader's arsenal is the manual trailing stop. Instead of setting a fixed stop loss, you move your stop to just below each new higher low, in an uptrend, or above each new lower high, in a downtrend. This technique locks in profits and protects capital. In the example trade, the initial stop was below the breakout point. As price made higher lows, the stop was moved up. When price finally reversed, the stop was triggered at a profit. This is why the trade was a half failure but still profitable. The trailing stop ensures you never give back too much profit, and it can turn a losing trade into a winner. Why do I keep losing on breakouts? Because you're entering without confirmation. Wait for the retest and rebreakout. But I'm afraid of missing the move. Missing a trade is better than losing on a false breakout. The market will always give you another chance. How do I protect my profits? Use a trailing stop. Move it to each new higher low. That way, you lock in gains. Here is a summary of the example trade. The entry was at 1301, the initial stop was at 1295, and the exit was at 1308. The profit was 7 points, and the risk was 6 points, giving a risk-reward ratio of 1.17. The trade duration was about 4 hours. This table illustrates the key parameters of a trade that used the trailing stop method. It shows how a trade that didn't reach its target still produced a positive result. Breakout trading is not for everyone. It requires patience, discipline, and a tolerance for frequent small losses. But with the right framework, it can be a profitable strategy. Remember these key points: most breakouts fail, so wait for confirmation. Use the 4-step logic to filter entries. Implement a trailing stop to protect profits. And understand that a failed breakout can still be profitable with good risk management. We'd love to hear how you approach breakouts. Stay disciplined. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.